Good morning, traders. It's Ben Nathan here from the Daily Forex School, and I'm here with a free lesson surrounding the non-farm payroll release and some activity we saw with the September release in particular. And I want to help you understand what happened, understand why it happened, and then use that information to then aid your trading going into the future surrounding such releases. Okay, so the release we're discussing is the non-farm employment change, or the NFP, which is short for non-farm payrolls. Now, it's probably one of the biggest releases, if not the biggest release of any month. So it's the 7th of September now, on a bank holiday Monday, and we've just had the figures released on the Friday just gone. So it's vital economic data, and it represents the change in the number of non-agricultural employed people during the previous month. So the reason why it's vital information is because it's a leading indicator of consumer spending, which accounts for a majority of the economic activity. So of course, the more people spend, the more companies need to employ people to cope with the growing demand. Now, typically, any figure above 200k is seen as fairly bullish for the US dollar. It's seen as a fairly good figure. Anything less is generally seen as bearish. Now, these are just kind of measures that are well known throughout the market and measures that tend to be fairly reliable. So, before we go into what happened, why was it so important this month? Well, the Fed, that's the Federal Reserve Bank of America, have been saying that they're going to do a rate hike on the dollar for the first time in several years. Now, a rate hike is generally seen as a fairly positive thing because it's the central bank's way of slowing down economy because it's growing either too fast or because the economy is exactly where it needs to be moving forwards. So it's seen as a really good thing. On the opposite side of the coin, if the economy is growing too slowly, then they cut rates to encourage people to start spending more. And then following from that again, the demand for employment rises. So a rate hike is definitely a good thing. It's been a long time since we've seen one from the Central Bank of America. So it's a big deal. Now, the things that the Fed have said they're looking for when it comes to deciding on a rate hike is labour and also inflation. So you can see there, with the NFP being one of the biggest measures of labour and therefore a good measure of inflation, the importance of it. Now, a particular reason why the September release was important is because there are two possible dates for a rate hike this year. We've got the first one being the September meeting, the September Fed meeting, and another one is December. So of course, September non-farm payrolls, a good indication of if we could have a rate hike on the cards for the September meeting. So what happened? Well, previous figures were 245k, and that was actually revised upwards from what was 215, and expected was 215 this month. So we expected to fall, but we still expected to stay above that 200k figure. Now, most of you who are members already know that what we'd said is we're only looking to trade better than expected news. We weren't looking to trade any bad news, and we're going to go through that in a moment. So you can see that the figure that actually came out was 173k. So not only was it lower than expected, it was also below that 200k threshold. So from that news alone, you would expect potentially to see a dip in the US dollar. But what happened? Well, here we are on the Aussie USD, following, well, just before the release. And what happened is, the release came out and we did spike upwards by about 28 pips, but then we started to rally downwards by about 61. And you can see there was a continuation of that rally until the close of the markets. So why exactly did the dollar strengthen amongst what was a pretty bad non-farm payroll release? Well, the simple answer is there was also other news. Now remember, what we said is the Fed are looking at labour and inflation as markers as to, you know, if they will or won't deal with a rate hike this month. So there are two other releases that came out at the same time. We've got the average hourly earnings, and it's released monthly, and what it means is the change in the price businesses pay for labour, and again that's excluding agricultural industries. Okay, so the reason why it's important is because it's a good indicator of inflation. The reason being, if companies are paying employees more money, then that cost will generally be offset and represented in the price of services. And therefore, because consumers are spending more money on things, that's a measure of growing inflation. And what happened is those average hourly earnings figures came out improved and better than expected. There was one more interesting release, and that was the unemployment rate. Now, it's not quite such a huge indicator, but it's still an important picture of the overall health of a country economy. Because the more the consumers spend, the more people need to employ others, and therefore unemployment drops. So what we can see is that the figure, which represents a percentage of total workforce that's unemployed and looking for work, in the previous month was 5.3%. We expected it to be slightly better at 5.2%, but what happened is news came out slightly higher than expected at 5.1%. So looking at the overall picture, while the non-farm payroll figure was lower than expected, well actually unemployment was down and average hourly earnings were up. So that indicates that we're reducing the amount of unemployed people, but also paying the employed people more, which means that consumer spend will be up, and of course inflation rises. And we know that inflation is a key indicator for the rate hike this year. So the market reaction and what we saw from the overall cluster of releases is that actually, while we did have a poor NFP reading, overall the average hourly earnings, the unemployment rate, things were still looking quite good for the USA, and therefore the rate hike was very much left on the table for the USA. So we still expect that we could see a rate hike in September, and that's why we saw the strengthening of the dollar even amidst a poor NFP reading. So I hope that this short lesson has helped you guys. Now, moving on from that lesson, we have got an offer that I wanted to put to you, especially for today, which is Labour Day. Now, most of you already know what the Daily Forex School is, so it's daily lessons via email on top of a live trading room and also a live news feed which is shared, and live trading of course. Generally, the cost is just $9.97 for 3 months access. We do a minimum of 3 months purely because we only really want to work with people who can commit to actually learning sensibly. So this isn't a get-rich-quick scheme where you can just jump on board, find a strategy, and then trade it and make millions of dollars, because it doesn't happen that way. It's as simple as that. It just does not happen. So we like to see commitment, and that's why you need to sign up for a minimum of 3 months. However, we have got a very special offer for you. So rather than bill you $9.97 for 3 months, because it's the 7th of September and it's Labour Day, we want to make things a little bit more fun and a little bit more exciting, so we're going to charge just $777 for Labour Day. Now the best part, what I'm going to do is I'm going to extend the length of time you get for that to 12 months, which is the amount of time I believe is plenty to go from where you are now to being able to confidently trade the markets and understand what's happening, and more importantly why. Now, I can't emphasize that enough. So we don't just throw strategies at people. We like to teach you how to think like a trader and how to invest while knowing exactly what's going on in the markets, but more importantly, what's causing it at any time. So 777 for just for 12 months access. So there's a several £1,000 saving there for you guys. So like I say, we always like to celebrate a bank holiday, and that's why we wanted to do something extra special today. And what I'm going to do, normally when we have offers that are this good, usually we'll only do maybe 10 at the most in terms of availability, purely because the live trading green is actually limited to 100 sign-ins. And the reason that is number one, to keep our costs down, because price jumps significantly when you go past 100 users, but more importantly, so that we can be there for our members and actually have enough of us to share out between the members, because the more and more people that sign up, of course, the less attention we can give. So 100 members, we can serve 100 members nice and easily. Therefore, we have to limit the offers. So rather than 10, we're going to stock in 20 of these offers. Therefore, you've got a good chance of being able to get hold of the offer. Now, what we're going to do is we're going to put a link in the comments section of this video, and also if you received an email, it'll be there too. And in terms of the date or the amount of time that's going to stay open until, we're going to leave it open until Friday. So you'll have till close of play on Thursday the 10th, just so that if any of you are celebrating the bank holiday, of course, you still have a chance to get the offer before the week finishes. So that's going to be going and live until the end of play on Thursday the 10th. And as I said, the link is either in the email that you've received, or if you found this video through YouTube or another section of the internet, you'll be able to find a link in the comments. So hopefully you enjoyed the lesson, guys, and hopefully I'll see you guys in the live trading green. Many thanks.